China is very much a top-down society. And under Xi, who's basically anointed himself as president for life, there's not an awful lot of concern about economic growth. India is a democracy, or nothing like what we would prefer, but it's a democracy. And the thing about democracies is that you can change regimes without revolutions.
Welcome to the Jay Martin Show. If you're new to the show, my name is Jay. I'm an investor. I'm here looking for the smartest home for my cash. If that sounds like you, then I think you're going to like what we do here. My guest today is Dr. Gary Shilling. He's the president of Gary Shilling & Co., a consultancy and money manager. Today we got into where he's putting cash and why. Conversations I'd love to have. Back up your thesis with your wallet. Let's find out what you're doing with your money. Right before we jump into this, if you are interested in building a portfolio in the commodity sector, then check out thecommodityuniversity.com. Myself, Rick Rule, Peter Kraut, Gwen Preston, many more friends have put together a 10-chapter video course for beginners who want to build a portfolio in the commodity sector. Very fun, very simple to follow. No complex counsel, just very simple, actionable advice. Check out thecommodityuniversity.com. And here is Dr. Gary Shilling. Enjoy. All right, Dr. Shilling, it's great to have you on the program. I appreciate you making the time.
Glad to be with you.
So I'd like to start with a bit of context when it comes to your portfolio, and then we'll unpack the macro narrative from there. And so beginning with capital allocation, Dr. Shilling, where are you seeing smart money move right now? Where have you parked capital? Where are you playing offense and where are you playing defense?
Well, our approach to investing is very much top down. We start with the economic, the political, the financial spheres, develop a forecast, and then see what investment themes follow from that. And they can be long or short. Being short is not unpatriotic in my view. They can be stocks, bonds, commodities, currencies. We want to cover the whole spectrum. Right now, we have basically a risk-off portfolio, which has been working for us, as you can well imagine. We're basically, and by the way, we're not stock pickers. We basically use ETFs, futures in some accounts, and so on. But we don't hold ourselves out to be experts in individual stocks. Right now, we're long Treasury bonds, which have been doing very well lately, and we can go into the reasons why on that. We're short stocks, which have also proved helpful. We're long the dollar. We're short commodities, particularly copper. And the one area that we're interested in a specific way is India. I think India has tremendous potential, and we use ETFs for India. So that's the portfolio, and we use it with all of our clients. We're not one from column A, one from column B. We tell people if they're interested in our approach and comfortable with it, welcome aboard. But that's the way we manage money.
Okay, I appreciate that, Dr. Shilling. I want to unpack this a little bit now. So I'm going to start with shorting stocks. So you're looking at specific sectors. Are you watching the rally right now in the S&P and having your doubts about the sustainability? Walk me through your approach right now to being short. And is this the broad equities market? Is this
we do it via the S&P and use exchange traded funds there. And I think that stocks are very vulnerable now because we are moving from a period of euphoria where a lot of people look for a safe landing to the realization that the economy is weakening, and that's particularly evident in the all-important labor area. So we're modestly short stocks. That's our smallest position, but I do think there's going to be further declines there. Early last year, we said we thought there'd be a 30% top to bottom decline in stocks from their January 3rd a peak of last year. They went down about 25%, rallied, have subsequently fallen. But I think to get to that target, you would take another 27% decline from here. And I think we're in or close to a recession, which will take down profits, change investor enthusiasm to pessimism. And so that's the rationale for the short stocks. But it's a very small, it's the smallest of position of any of our positions.
Okay, that makes sense. And thank you for that context. So when you look at the rally in the S&P right now, what you're waiting for is recessionary effects to take down corporate profits, destroy investor sentiment, their bullish sentiment. That'll trickle into the market. What do you make of the rally that we're watching right now? What's behind this rally, Dr.
Well, as I mentioned, I think it is enthusiasm that inflation is coming down and the belief that we're in a soft landing. But what is more important to me than what's happening in stocks is what's happening to Treasury notes and bonds. That's where the action has really been. And that's a much bigger position for us, and it's been working very well. And I think it is based on the idea that the economy is slowing. The Fed isn't going to turn around and shift toward ease immediately, but it will eventually. But in the meanwhile, with a recession, there'll be a lot more interest in treasuries as safe havens, a lot less competition from other forms of borrowing and so on. So treasuries are much more important to us than stocks.
Okay. Walk me through your long treasury and long US dollar thesis.
Well, it's the same thing. The dollar's a safe haven. And when you have trouble around the world, investors flock to the dollar. And it's really interesting historically, even if the trouble starts in the US, that's where investors go. They go to treasuries, they go to the dollar as safe havens. And the dollar, as I'm sure you know, has been very strong in the last year. I think it will probably continue to be a safe haven effect.
Okay. And do you watch the de-dollarization conversation? Are you following these threads? What's your take on the US dollar losing any influence or status when it comes to global trade and exchange?
Yeah, we've done a lot of work on that over the years, and going back to actually ancient times, ancient Greek and Roman times, and we've looked at the characteristics for leading currencies in the world. And they are historically associated with large economies, which the U.S. is obviously the largest, free markets, which the U.S. has. Now, China would love to have its currency, the yuan, as an international currency, but they want to control it. And international money does not go to control currencies. It goes to free currencies. So free currencies is one. Open markets. And if you look at the size of U.S. Markets in terms of stocks and bonds, they dwarf anything else in the world. You look at all these various characteristics that historically have been associated with strong currencies, and that's where the dollar is. Now, people can argue that the dollar is going to be dethroned and so on, but 88% of total international transactions today involve the dollar. The dollar is preeminent. Nothing else really. There's really no second.
So what do you make of pundits who would claim that the United States empire is entered its sunset years, that the US dollar is weak and the world has realized this? In addition, it's no longer safe because sanctions can weaponize the dollar, as you know, we've seen a few examples of. This is hyperbole, sensationalized headlines, or what's your take there?
Well, what's new in that explanation over the last 50 years? I've been hearing that for 50 years. There's always that chorus of doubters, but so far they've been wrong.
Yeah. Okay. Got it. Do you think that when the United States essentially weaponized their currency in response to the Russian invasion of Ukraine, that sent a message to central banks around the world that said this safe haven might not be as safe as it used to be? Or do you think it was less of an event than people make it out to be?
Why do you say the U.S. has weaponized its currency? I don't understand your remark.
Confiscating $600 billion of USD reserves from Russia in response to their invasion of Ukraine. If US dollar reserves are the safe haven of the world, it sends a message that maybe they're not, because the US can sanction these reserves if they see fit.
Well, that's a pretty small percentage of the international dollars out there, and I don't think it's a meaningful development.
Okay. All right. I appreciate that. Thank you. So walking down further through the portfolio, short commodities. So is this in response to forecast of a global recession? What's your short commodity thesis right now?
Yeah, well, commodities are very supply and demand dependent. But you got to be careful with commodities because some commodities, oil in particular, have cartels to deal with. In other words, a very correct analysis of supply demand for oil can be upset when OPEC Plus comes out tomorrow with some announcement they're going to either cut or increase production. So yeah, oil has been weak. Oil prices are down 32% from their peak last summer. But my emphasis is on copper as far as commodities. Now, it's only one of many commodities, but I like copper in particular, and particularly in our portfolios on the short side, because a number of reasons. One is copper is used in almost any manufactured product. It's used in plumbing, it's used in cars, machinery, you name it. It's got some copper in it. Secondly, copper does not have cartels on either the supply or demand side. So the economic functions act very well. Third reason is that copper producers such as Chile desperately need dollars to service their foreign debts. So when the price of copper goes down, what do? They increase production. They don't cut it back. It doesn't act as a normal economic commodity. They actually increase production to get the same number of dollars to service their debts. So the weaker the price, the more they produce, the weaker the price. It's a self-feeding cycle. That's not the only commodity that behaves that way, but it's a very, very big internationally traded. They say it's the commodity with a PhD, and I think there's merit to that position. But that's the commodity that we use when we're shorting in our portfolios.
Okay, and it is more or less a barometer on global economic health.
It is.
It is
on particularly manufacturing. Yeah.
Particularly in manufacturing. Okay.
Yeah.
The era of globalization has now come to an end. Countries and corporations are right now racing to secure the materials they need for their supply chains. If you are serious about your portfolio for 2024, then get yourself to the Vancouver Resource Investment Conference in Vancouver, British Columbia on January 21st and 22nd.
Do you factor in gold into your portfolio? Would you put that in the commodity bucket or?
I'm agnostic on gold, and I'll tell you why. Gold is moved by a whole host of factors. If you go back in 1987, gold went up to what was then a very high price, $800 a month, and it went nowhere for 20 years. To be equivalent today, you'd have to be, I think, about $2,500 an ounce on gold. But the problem I see with gold is there's so many forces that push it around. Inflation, deflation concerns, political risk, flight capital, working over old gold tailings to get more gold out of what they threw away previously. There's an awful lot of sources there, and I just find it, at least I'm not smart enough to sort them all out, so I'm just agnostic on gold.
Okay, yeah. And so not on the portfolio then, correct?
No, never has been.
Never has been. Okay, got it. Okay. India ETF. So you're looking at emerging markets, but India is what you're focused on. Is that correct?
India specifically.
India specifically, okay.
Yeah, India specifically. There's a number of reasons for that. And part of it is a fading star of China. I mean, China is a top-down regime. It's manufacturing oriented, and the facts are that as economies increase, more and more spending is on services proportionally and less on goods. You can only put so many cars in your driveway, but you can have almost infinite spending on travel, recreation, medical care, etc. Indians are good at services, technology. China is good at manufacturing, so that's one advantage. China is very much a top-down society. And under Xi, who's basically anointed himself as president for life, there's not an awful lot of concern about economic growth. Yes, enough to keep the populace at bay, but economic growth is very low on their list of priorities. It's really keeping control, indoctrination, communist views, and Xi has made that very evident in recent years. So that's China. Now, that's important because China has been the locus of globalization and a lot of interest there, because I'm sure you're aware China now has some very big problems with excess investment in property, a lot of bankruptcies and bailouts necessary by the government. They're trying to get more consumer spending. Therefore, they're increasing minimum wages, and that's driving a lot of low-end manufacturing out of China into Vietnam and so on. So this is really in a part of contrast with China and India. Now, let's go to India. India has a number of advantages. Now, India is not perfect by a long shot, but India is a democracy, and the value, and it's a messy democracy, to be sure, nothing like what we would prefer, but it's a democracy. And the thing about democracies is that you can change regimes without revolutions. A top-down society, the only way you change the regime is a revolution. You got to throw them out. Mm-hmm. We've seen that the Russian Revolution, the French Revolution. I studied China, 5,000 years of dynasties, and they usually get tossed out because of civil unrest. But no top-down regime ever quits voluntarily. India has a democracy, and you look at now with Modi's party in control, taking over from the Congress Party, which dominated after World War II. That's been a relatively peaceful transition. So democracy is important, particularly in terms of long-term stability. Secondly, Indians are good at technology. As I mentioned earlier, technology grows in terms of spending and goods relatively declines. Indians are good at technology and much better. And the Chinese are good at manufacturing, but that is a decided shift in favor of India. Third, Indians speak English. At least a lot of the people who are involved in the international area speak English. And that's pretty handy in today's world, speaking English. Fourth, India inherited a legal system from the British. Again, it's not as nearly as clean as we would like, but it is a legal system. It's not like the kangaroo courts in China. So I think there are a number of things that suggest that India has great potential. And a final thing, of course, is that India has had no control on population. China did you go back to Mao, and as a result of the one child per couple, the working age population in China is going to decline for the next 4 decades. That's demographic facts. That isn't going to change. And whereas India, there has not been any control. They have a much younger, more adaptable population. So those are, I think, major forces in favor of India, and I think India has great growth potential.
Yeah, I mean, you outlined a pretty compelling case there. The demographics alone of India, I think, are some of the best in the world. But adapted technology, English-speaking population definitely helps. Inherited the British legal system, and the population controls that are going to be realized as quite detrimental in China don't exist in India. What's your take on the longevity of the BRICS? Because there's a lot of weight put on this as a syndicate of power, but the ideologies of these countries are very different, and I would expect cause some fracturing in the near future. Do you have a take on that?
Yeah, I don't think it ever was a very coherent group. I think it was just a group of 4 or 5 countries sort of thrown together because there was the expectation they all were going to be growing rapidly. But I don't think there was much more than sort of a figment of analysts' hopes and amalgamation. But I think they're all very different. South Africa is certainly very different than China or India. They just, I just don't think as a group it means much.
Given what you shared on China, that you said the fading star of China and a powerful country in decline might be incentivized to take aggressive action sooner than later, right? Before their power diminishes. And so there's a lot of tension in the South Pacific right now, in the South China Sea, a lot of conversation about, will or will China not arrive on the shores in Taiwan. Do you have any perspective on those geopolitical implications? Well,
that definitely is an issue. In Shakespeare play Henry IV, Part 2, there's a great line that says, it says, busy, giddy minds with foreign quarrels. In other words, if you got problems at home, start foreign wars to divert attention. And that's what the Chinese are doing. Their Belt and Road policy has been a financial disaster. They were attempting to buy their way into places like Sri Lanka, which really is just a complete disaster, and so on. And they're really trying to buy their way around the world, and it just hasn't worked. But it doesn't mean they're not going to continue. And of course, a big question is, are they going to raise more hell with Taiwan? And that gets pretty serious, because we've got some, I think, pretty firm commitments to defend Taiwan. But yeah, I think China could very well try to create more difficulties around the world. And again, as their domestic economy fades, again, busy getting minds with foreign quarrels.
Yeah, interesting. I'd love you to walk me through, if you don't mind. You said the Belt and Road Initiative's been a financial disaster. Could you outline that case for me a little bit?
Well, the whole idea was that China was going to invest in a lot of these areas and basically make investments there, and in effect buy the allegiance of these countries. The problem is that China, unlike the U.S. and other Western countries, they did not provide this aid pretty much with no strings attached or very low interest rates that a lot of times get forgiven. Let's face it. But China, they lent this money with high interest rates, and they've really demanded control in a lot of cases. Sri Lanka, I think, is probably the outstanding problem area, but they basically said, if we make the investments, we want control. And a lot of these countries have no way of repaying these debts that they've incurred to Chinese investments. China's also insisted on using Chinese contractors and Chinese labor. It doesn't help the country very much if they move in with all their contractors and equipment and labor and so on, and don't employ and train the local people. So it may look good on paper, but it doesn't really do much good for these countries, except to saddle them with debt that they're never going to be able to repay anyway.
Okay. I appreciate that. Any other emerging markets outside of India, Dr. Shilling, that are catching your attention as worth a look?
I'm sure there are some, but I haven't. I've been following India for a long time, and it's for the reasons I articulated earlier. Have been very impressed with India, and we're invested there, but that's the only one. And there probably are others, but I just haven't done a detailed search, and none of them have come to my attention.
Yeah. Okay. All right. Dr. Shilling, for anybody who wants to hear more from you, I know you publish a newsletter, and anybody who's interested can find that at agaryshilling.com. And just for context, there's no C in Shilling, just S-H. Shilling.
Used to be about 4 generations ago. Well, I had a great-great-grandfather who he said, well, you don't pronounce it, and it takes extra ink to write. So he voluntarily took it out. It's German, but he took it out.
That's hilarious.
And we've been living with it ever since.
Can you walk me through what people receive in terms of your distribution and analysis?
Yeah, and we do have a monthly newsletter, and if anyone would be interested in seeing a complimentary copy, we do have a toll-free number, and the number is 888-346-7444. 888-346-7444. Be happy to send you a complimentary copy, and you can sort of see what we're doing. Our December issue is a rather interesting one. It goes back 41 years, as a matter of fact, to when I first started forecasting deflation. I wrote an extensive article for Fortune magazine in 1982 on this, and a lot of this issue is really looking at, how did we do? How did we come out? And it has evolved, not 100%, but it's evolved pretty well. But I think it's indicating a lot of the disinflationary themes. And disinflation means lower and lower inflation rates. Whether I don't think we're going all the way to deflation, widespread declines in prices, but disinflation, and they've worked out. But what's also important is what of these themes are still viable, and that's what we concentrate on in this December issue. So if anyone's interested, we have to send them a complimentary copy.
Okay, appreciate that. And agaryshilling.com. Look, I appreciate your time today, Dr. Shilling. It's been great having you on and chatting with you, getting some perspective on where you're focused and where you're allocating capital. So thank you very much.
You're welcome.
All right.
Commodity investing for beginners. No complex strategies, just actionable information. Our comprehensive course breaks down the complexities so you can make informed decisions and gain financial freedom.